All right, to talk about markets, geopolitics, Fed policy, and everything in between, we're joined by Brent Schutte, Senior Market Strategist at BMO Global Asset Management. Brent, good to have you on the show.
Thanks for having me.
Brent, stocks are down a little this week. Now, from a technical analysis point of view, we have an interesting development, death cross, if you will, forming in the Russell 2000. This is usually an indication that a bear market is on its way. What do you think?
I think the small caps are a little bit different of a story than what people are telling. If you look at small caps historically, they are pretty much linked at the hip to Fed easy policy. And so if you look back historically, anytime the market has easy policy, small caps tend to outperform because the Fed is underwriting risk. Now you're having the Fed potentially coming out of the market. And when that happens, small caps tend to underperform. And so I don't think it's an economy slowing. I think it's just money coming out of it.
But usually it's the small caps that get the boost when the economy is doing well. And the Russell 2000 index is down 3.9% for the year. Why?
Small caps have had a 13 or 14-year run based upon largely negative real interest rates in the U.S. And so they're overvalued versus large cap companions, and they don't have the Fed tailwind anymore. If you think back, and you can remember back to March 19th, Janet Yellen made a mistake at a press conference, and she said considerable time period was maybe 6 months. The market fell. Small caps on that day reversed their leading part in the market and have been down ever since. And so I think small caps are more of a story on the Fed than anything else.
With Fed policy obviously affecting the major indices as well, they've had a bit of a rough couple of days, yet you are still bullish.
Sure, I'm still bullish, but it comes with a caveat, like everything else in this business. I think you're going to have to withstand some more volatility. So over the past few years, volatility has been low because of what the Fed's done. As the Fed comes out of the market, volatility should pick up. It has historically. 94, it picked up. You had a market correction. 2004, you had 5 to 7% corrections. And so I think you're probably going to see a correction at some point in the future. But I think the economy's, you may be seeing it right now.
Is this the correction that we've been calling for, Brent? If you look at the bigger picture, we have airstrikes against Syria, the rise of IS, Islamic State, a potential slowdown in Europe. We saw Germany and France's economies contracting. China's showing signs of a slowdown. Tensions in Ukraine with Russian sanctions against the US and Europe, US sanctions against Russia. What is a reason to be bullish?
The geopolitics are always out there and the hardest thing to predict. And that's why economists always say barring any exogenous shocks, which mean things that you can't factor in. I think if you look at the U.S. economy, there are a lot of underlying strength within the U.S. economy.
But the U.S. economy does not function in isolation. It's dependent on the rest of the globe more and more so.
Absolutely.
So we can't dismiss geopolitical tensions.
I think the big thing is that Mario Draghi gets that. And I think if you look at Europe, he has now got a coalition of people who are willing to actually do monetary policy. Whether it works or not longer term is still out there for discussion, but I think he's willing to do whatever it takes now, and the market's going to make him actually do that.
Brent, the NASDAQ is up almost 8% year to date. A lot of people are saying we are overdue a bubble. One of them, Mark Faber, Doom, Gloom, and Boom report, he is saying there is a bubble everywhere. Mohammed Al-Arian saying today there is too much exuberance in the markets. And of course, Fed Chairman Janet Yellen also alluding to overvaluation in social media and tech stocks.
Sure.
What's your thoughts on the NASDAQ?
On the NASDAQ specifically, I think it goes along with small caps also. I guess I kind of take it differently. I think the exuberance has been more in bonds over the last few years. If you look at where the flows have been from investors, they haven't been into equities, they've been into fixed income. And so if you're looking to de-risk something, I think de-risking your high yield bond portfolio, for example, is something that would make more sense to me than de-risking the equity side of the equation. Certainly valuations aren't what they were, but I do think economic growth will strengthen in the U.S. or at least stay where it is right now. And that is a backdrop for stock gains, not stock losses.
And you think financial sectors is the one that's going to benefit most from this?
You actually, the thing that changed with the economy over the past few months is that the banks are actually beginning to lend. And so you've seen bank loans tick higher, which typically is how the economy functions and how the money that the Fed has put into on the banks gets into the economy. As that happens, financials typically do well. If you look over the past few months or few years, anytime the 10-year Treasury rises, financials outperform.
At the same time, we're seeing an interesting development. The UBS Wealth X Index is showing that billionaires, very uber wealthy people, are keeping 19% of their assets in cash. Usually this is a sign that they're a little nervous out there. What do you make of that?
It goes back to your exuberance comment. It means there's money on the sidelines that's yet to come in.
You think it's still going to come in and going to come into equities?
When those people put their last dime into equities, that's when I become more concerned. Because there's less people to actually become bullish. It seems like people have fought this thing all the way up, and that's actually a decent thing. It doesn't feel like 2006 to me, and it certainly doesn't feel like 1999.
So where do you see the market at closing at this quarter?
Sure, I think you're in more of a transition period. So I mentioned monetary policy and how things change. If you think back to 1994, the S&P finished up 1% or 2% for the year. If you think back to 2005, a transition year with rates, the market was up 4%. I don't think you're going to have explosive gains. That being said, you're getting into a seasonally strong period of time where you could see market gains of 3, 4, 5% towards the end of the year.
What do you think could be the game changer?
The game changer, where I would be wrong?
Yes.
Geopolitical. I mean, I think today's market action was strictly because of what happened last night in Syria, not necessarily what happened with the Fed.
So still strong fundamentals pushing your vision forward.
Yep.
All right, we're going to have to leave it there, but thank you so much.
Thank you.
Brent Schutte, Senior Market Strategist at BMO Global Asset Management.